What's up, you guys? So I wanted to share with you guys one of my bigger purchases in my life, and that is, how I purchased my first home. So buying a house is a pretty big purchase. I mean, it's probably one of the larger purchases that you'll ever do, and you want to make sure that you have some base foundational knowledge so that you don't make a lot of mistakes that I'll admit that I made. So I bought my first house back in 2009, and I made, I don't know, countless mistakes, and I'm here to share with you some of that stuff. All right, my first tip for you guys is to make sure that you guys are patient. And so a lot of the tips that I'm going to be talking about is going to require a lot of time. And if you're not making a lot of money, or you don't have a lot of money already, these things can seem like, hey, I'm trying to prevent you from buying a home. And that's not what I'm trying to do. I'm trying to make sure that you guys set yourselves up to have a nice foundation so that, you don't become that couple or that person that's, house poor and, they have to eat, a cup of noodles all day or something like that. And so, just know that this process can take a while to buy a home. I mean, if it was easy, everybody would have a home. And so, this is going to be your largest purchase probably for a long time until you buy maybe a second home or something like that. And so you want to make sure that you do a lot of research and you buy the home that you want, at least for semi long term, and you don't make a lot of mistakes that will cost you later. The second tip I have for you guys is to make sure that you guys know what you want in a home. And so start by making a list, writing down what you want. You want a kitchen? Do you want a gas stove, electric stove? Do you want a washer dryer unit? Inside, do you want a 2-car garage, attached, detached, 3-car? Do you want a corner lot, backyard, etc., etc.? The list can go on. And the easiest way to kind of figure out what you want is to, look at what your parents have, look at what your friends have, go to their houses. If you're not living at home, if you're already renting, that's a good way to figure out what you want and what you don't want, right? If you're living in an apartment, you probably want a garage because parking is probably a really annoying thing to do in an apartment. And so jotting down that list will help you kind of narrow down what you're actually looking for. And that list will actually come in handy when you get a real estate agent, because they'll take that list and actually find you homes that match most of those criteria. It's a good idea to also prioritize those things, because you're not going to find a house that has everything on that list. For example, my home here that I bought, it doesn't have my, RV or side parking that I would like, right? And I didn't actually learn that until, I bought this second house. But it's a good idea to have that list in mind, so that way, when you're going around and looking at homes, you kind of have an idea for what you want. Now that list is going to change, over time. As you see more homes, you're going to see things you want, which is fine. Just make sure you write down that list, agree with your partner if you're buying it with your spouse, and start there. So the next tip I have is to make sure that you pay off all of your debts. And what I mean by debts is things like credit cards, car loans, student loans, personal loans, payday loans, whatever you have. You got to get rid of all of that, because what's going to end up happening is the lender is going to pull a credit report, and they're going to see, who you owe money to, and they're going to calculate something called a debt to income ratio. And this is the amount of money that you owe, someone every month, and they're going to add it all up and calculate, how much that debt is compared to how much your monthly income is. And that ratio, ideally needs to stay under 30%. Ideally 0% is the best, because that means you have no debt. Because once you start adding on your monthly mortgage payment on there, it's going to jump up there way high. And so they want to make sure that you can pay back the loan, and you have no issues doing that, and you don't want to be house broke either. My next tip is to make sure that you fix your credit. And so before you actually run your credit with the lender, you can run your own credit report, and you can get a free credit report every year through annualcreditreport.com, or pick your favorite. I'll leave a link for you guys down below if you guys are interested in doing that. So what you want to do is review all of your outstanding credit and make sure that, for one, it's accurate. If you have a car loan, that the car balance is correct on there, the monthly payment's correct, the origination date. If you paid off a car, make sure it shows as it's paid off, that it's closed. Because once you start the loan process, the lender is going to do the same thing. They're going to pull the same credit report and they're going to look at these things. And ideally, you don't want any surprises during that process. Now, even if you do get surprises, you don't have to pay for a lot of the fees associated with starting a loan, but it's a big headache, and if you're preparing for a house, you want to avoid all of those things. Now, if you don't have any credit, this is a problem that I see sometimes with some folks. They're really old school and they buy everything with cash, which is a good discipline to have until you need to borrow money to buy something like a house. And so most people aren't going to have enough money to buy a house, flat out. If you do, great, good for you, thumbs up. But a lot of us, it takes a long time to save that kind of money. And if you live in California like I do, the homes are slightly more expensive and it takes a really long time. So if you want to build your credit, I suggest you start with credit cards. I mean, you'll get letters in the mail. I don't suggest going with those. You can go with like cash back rewards. You can go with a Costco credit card. Those are pretty good. And you can just, instead of paying with cash, just charge it on the card if you're already buying things, and then just make sure you pay it off every month. Doing that for a year or two, you're going to raise your credit score by quite a bit. And by having a good credit score and having that ability to repay back that debt, even though it's already money you already had, it kind of shows the lender that you have the ability to pay back their loan. And so you want to make sure that your credit score is pretty high. And one of the things also that can affect your mortgage payment is your credit score, because your interest rate for your loan is going to be highly dependent on what your credit score is. And so you want your credit score to be very high, at least 750 or 760. A lot of you guys will probably be around the 720 range. I know the credit scores have changed recently, but when it was I think 800 max, I think my credit score was around 705 or 720 when I bought my house, and I had no issues with my credit. And so it was really hard to get up there. Nowadays, I think 850 is the max. I'm at around 804 or 815 or something like that. And I think, as I started paying off debt and paying off cars and paying off homes, that score went up really high. And so most lenders will be, sufficiently happy with people who are above the 700 range, maybe 720. And, you want to make sure that your score is that high before you actually go and get a loan. Now, a lot of you may already have credit because you have car loans, and if you paid off all of your debts like I mentioned earlier, then your credit score is going to be pretty high already, and you shouldn't have to worry about this. But if you don't have any debt, I suggest you go open a credit card, get some of that credit card reward. I mean, there's a lot out there, and to be honest, credit card companies are rewarding people for having good credit. They're basically gambling and they know that people are going to make mistakes and probably buy things they shouldn't buy. But if you're disciplined, you can take advantage of that and also build your credit at the same time. Once you get to a point where you don't need a lot of money, all of these credit reward programs are actually very beneficial for you because you get stuff for free. If you're interested in a couple credit cards, I recommend, I mentioned the Costco credit card. It's just a good all-around card. I have also a Chase Freedom Unlimited. I also have an Alaska Airlines card, which is good for travel. I don't suggest you open too many. Maybe 2 is a good number already. So you can add a secondary card and give it to your spouse or someone to use. And just make sure that once you get your card, you set it up for auto payment automatically to pay the full balance, or just manually pay it every time you feel like it, which is what I do. I actually do both. The auto payment more is for if I forget, and if I get too busy with work or something and I kind of just forget about my credit cards for some odd reason, which has happened before, and I've been saved a couple times. I mean, the worst thing that can happen is if you forget to pay your balance and you go into the fees territory where they're charging you interest rates and late fees. That's where the credit card companies make most of their money. So you want to make sure that you set the auto payment up and just leave it as automatic, and then you don't have to think about it as much. So this next tip is probably the harder tip, and it's probably not as hard as paying off all your debts, because paying off all your debts is a pretty hefty feat. But this one's pretty hard as well, and I think it's going to be hard for a lot of people, and that is saving a lot of money to buy a house. And so buying a house is not like buying a car where you can go in there and put 0% down. And cars are generally, less expensive than homes, and so even if you had to put like 10% down, it's not that much money. But for homes, home prices can range, in California, at minimum $200,000 all the way up to $1 million, depending on where you live. I think the median house price in my city is about 250 or something like that. And so, if you had to come up with 10% down, that's $25,000. If you had to come up with 20% down, which is what I recommend, that's $50,000 you would have to buy a house. Saving a lot of cash is going to be very beneficial for buying a house for several reasons. One, it's going to lower your monthly payment to something reasonable. And two, you're going to avoid a lot of things like PMI, which stands for private mortgage insurance. And what that is basically if you don't have enough skin in the game, if you didn't put your own money down, the banks want you to pay for this insurance in case you default on your loan. And it literally has no benefit to you. It only benefits the lender at this point. And you're just paying it. It can range from $50 to $100 a month, depending on the amount of money you're borrowing. And it literally does nothing for you. And they roll it right into your monthly payment as if you don't even know about it. And you just pay it every month until you get to a certain point of the loan, depending on the loan, and then it drops off. Another reason why you need a lot of cash is because of closing costs. And so closing costs is the cost to get the loan and close it and do all of the escrow exchanges, the titles, the deeds, the paperwork, all the shipping, basically anything that has to do with, transferring that house to you. And so closing costs typically runs about, 1% to 2% of the purchase price. It's kind of a rough ballpark. Kind of depends. There's lenders out there that will do it for less. There's lenders that will do it for a lot. And you'll kind of have to shop around. I'm going to recommend a company that I used when I bought my home. My second time, not my first time, so you guys can learn from this. And they have very low fees, and I'm not sponsored by them or anything. I'm just trying to help you guys save some money. I've shared this lender with a lot of my coworkers and friends and family, and their rates are really low, and you actually can check their rates at any given time. A lot of the lenders won't even tell you the rates until they run your credit. So I'll leave a link down below. The name of the lender or the broker, I guess, is Box Home Loans. And they only do loans in certain states and cities, so you have to check their website. But they've been easy to work with and low fees. Another reason why you need to have a lot of cash is a lot of lenders require you to have cash reserves after closing. And so after they've handed you the keys to your home, after all the down payment, the closing costs has been paid, they want to make sure that you actually have money left over in your bank account to pay for the loan. And so, let's say your monthly payment was $1,500 a month. Some lenders will require you have at least 3 months of reserves in your bank account, or some of them may even go up to 6 months. It kind of depends on the situation. And so that can range from $4,500 to $9,000 that you have to have after you've already given them, your $40,000 plus the 1% to 2% closing costs. And so you're looking at about $50,000 here, or maybe a little bit more than that, to buy a $200,000 home. Now, say you didn't have 20% down to put as a down payment. I didn't have 20% down. If you're starting your career in your 20s, you're probably not going to be making that much money. And so what ended up happening for me is I went with an FHA government loan, and they only required about 3% down back then. I think it's 3.5% now. And so I had to come up with about $8,000, I believe it was. So it was a little bit easier, but like I mentioned, I was penalized for doing that because I had to pay PMI, and I think it was around $70 a month or something like that. And back then, when FHA was pretty new, the PMI actually dropped off after 5 years. So I thought, okay, that's not too terrible because after 5 years, I'm most likely not going to drop off my PMI by getting to 80% because I can't assume home values are going to go up. And so I thought that was a pretty good deal. But nowadays, if you get an FHA loan, you can do 3.5% down if you really want your house. And that PMI it actually doesn't drop off ever. There's a new rule that they keep changing this every so often, and that's why I really hate FHA loans. And I don't suggest anybody get one. But it doesn't drop off at all. If you put 10% down on an FHA loan, it will drop off, I think, after 11 years. Don't quote me on that. Do some research. But to avoid all of this, you want to just go with 20% down and get a conventional 30-year loan. That'll be the easiest route, and that'll be the cheapest way to pay the least amount of money. All right, the next tip I have is to make sure that you have a decent work history. And so, if you haven't been working too long, like I mentioned, you got to be patient. You got to work in that industry for a while. The lender is going to request that you have at least 2+ years in the industry. That's mainly because they want to make sure that if you got laid off or you got fired or you decided to quit your job, that you can actually find another job that pays similar salary that you're making now. And so, if you just started and you just graduated from college, one, you probably shouldn't be buying a house. You probably don't need a house yet. But they're going to want to see to make sure that you're actually employable and that you can get a new job if everything hits the fan. And they obviously don't want you to default on the loan, because that's how they make their money. You pay their interest for borrowing their money, and they want you to pay that interest forever. So make sure you have at least 2 years of work history in your field. If you have multiple jobs, hopefully they're kind of similar, but they're going to want to see that, and they're going to ask that question when you go and get your loan. All right, guys, we haven't even started looking at homes yet, and we're already probably halfway through this video. But now that you've kind of taken care of all of those other things, you can finally start looking at homes. But before you even do that, you might want to consider getting pre-approved first. The reason why you want to do this is because you want to make sure you understand how much buying power you have for the situation that you're in. And so you don't want to go look at $1 million homes and realize you can't afford it, because that's just wasting everybody's time. And so you can run a couple calculators online. They'll probably have very conservative estimates, which is probably a good thing. But it'll give you an idea of let's say you made $80,000 a year in your household. You could probably afford, I don't know, $300,000 or something like that. So getting pre-approved will kind of let you know what amount of house you can buy. So what I suggest, and Dave Ramsey is going to hate me for this because he suggests 15-year loans, but I suggest you get a 30-year conventional loan. And the reason why I suggest that is because 15-year loans are kind of excessive and very expensive for a lot of home buyers. And if you get a 30-year loan, you won't be as house poor, and also your home's probably going to appreciate in value, and it probably won't be your last home, so you may actually end up selling it down the road, 5 years, 10 years, whatever. And even though 30-year loan at 4 to 5% sounds terrible, your home may actually make you money. So I'm actually okay with 30-year loans and paying interest on it. I will say that I would stay away from FHA loan. I know the 3.5% down payment is very enticing, and a lot of people they become impatient. Another reason why conventional loans are good is because you actually can get a conventional loan with just 5% down. You actually don't need to put 20% down. 20% down is just to avoid the PMI, but 5% actually is a decent down payment. It's a little bit higher than 3.5, but it's not that much more. And so saving up a little bit extra to get to that 5% is going to be worth it. And I'll tell you why. Because on conventional loans, unlike FHA, you actually can remove the PMI. And there's a couple ways to do it, and one way is literally just to pay down the principal to get to 80%, and you can actually request the lender to drop the PMI from your account. Now the weird thing is that you have to request it, and I feel it's kind of shady, but it is what it is. But once you get to 78%, the lender will actually automatically drop it off. But once you get to 80%, it's in your best interest to call the lender and tell them to remove the PMI, because you're literally paying for their insurance. It doesn't make any sense. So like I mentioned, I recommend a company like Box Home Loans. I've used them a couple times, and one of the nice things about this lender is they have a very low origination cost. Most loans will cost you, I believe, 1% of the purchase price. So a $300,000 house, that's a $3,000 fee you're going to have to pay in your closing costs. Box Home Loan actually only charges, I think, $149, which is kind of ridiculous in my mind. But that's just the way they do business. Another thing is they're pretty upfront about all of their fees, and one thing you'll have to be careful about when buying a house is all of the fees that these lenders put in there, and you may not even know what half of them are. And to be honest, you won't know what half of them are. I didn't know what half of them are. But one thing that's really nice about this lender is they will write out and itemize everything and show you, where all the fees are and what they are. Just know that I'm not sponsored by them, but I would go and use them instead if you want to have a low fee loan. Alright guys, I wanted to show you really quickly how you can check the rate for today. So today is December 31st, 2019. You can see here I'm on the Box Home Loan website, and literally it's the middle tile here. You can just click that and it'll give you an instant quote. You don't have to do anything. You don't even have to put in your personal information, nothing. You can just check what today's rates are, and like sometimes I'll check if I'm curious. So here you'll want to do purchase and put an amount here. So let's just say you're looking for a $300,000 home, for example. It's going to pre-populate 20% because it's just what they recommend. And then primary residence, single family, I'm going to put 780, and I'm just going to put somewhere in California so you guys don't stalk me. Kidding. So I'm going to go ahead and click Get Rates, and you'll see you can uncheck certain loan years. So I'm just interested in conventional 30-year, and you can see it's already come back with 12 rates. So one thing you'll notice here is there's a total cost column, and then there's a rate column. So you're going to want to look at both of those. Ignore the payment for now because that's your monthly payment pretty much, your P&I, principal and interest. But basically what it's telling you is today you can get a loan for $240,000, I think that's what I put earlier, for 4.125% and pay pretty much no closing costs. And what this means is that they're just giving you a credit. You can see here it's in parentheses. That just means the lender is giving you a credit to kind of close this loan. Now if you want a lower rate, and you can kind of see that there are lower rates in here, and sometimes they'll refer to this as paying down your points or paying down points so you can get the interest rate lower. I don't suggest that usually because you'd have to keep the loan for a really long time before you actually get your money back. I suggest you try to keep your closing costs as low as possible. But you can see here, this 3.75% loan would cost you about $1,588 to close, and so this will be tacked onto your closing costs when you close your loan. So if you want to look at what your loan costs are, you can see here, like I mentioned, Box Home Loan is really cheap, and it looks like they raised their price a little bit since the last time I used them, but it's still $199 is really cheap for a loan. So this is the typically what's called the origination costs, and you can see this in your good faith estimate, and you can even compare it if you want. I recommended that you get 2 pre-approvals, and you can see that this company is much lower. Typically it's 1% of the loan, so in this case $240,000, 1%. You're paying $2,400 just right off the bat, so you've already saved $2,200 just right here. Another thing is the third-party charges. So these things, this will always happen with any lender. Some lenders will actually add more things in here, so you have to be careful about that, and you can even challenge them and ask them what the heck all those things are. But typically an appraisal has to happen. This is when they calculate how much your house is really worth, because they want to make sure that it's worth that amount. Obviously all the credit checks that they're doing on you, somebody has to pay for that. So they're charging you for that here, and then the title company and the title transfer and all the escrow stuff. So that's just what's listed here, and they're just really upfront with all of that, and they're really they're not trying to make money off of you from third party and fake charges. They're just trying to get you a good price on your loan. And then this is just your city's recording fee. Every city is going to have something. This is for the deed and transferring the title. And then here, taxes, insurance, and interest. So taxes and insurance are your property taxes and your homeowner's insurance. And we'll talk a little bit later about that when you have to go get your homeowner's insurance. But it's TBD because they don't really know what your home insurance is going to cost, and they don't really know what kind of property you're buying and what your city charges for property taxes, so it's TBD. This number, or this section of the itemized statement, will always be the same no matter which lender you go with. So really, if you're going to go pick another lender, make sure you look at the loan costs and compare that apples to apples, because this here will be part of your closing costs no matter what, and that part doesn't change, right? Because you have to pay property taxes when you buy a home, you have to pay your homeowner's insurance when you buy a home, and then the interest part is just the prepaid interest that they're going to charge you while the loan is kind of in escrow, because there's a couple days in between there that you have to pay for. So here I've expanded all of the rates out, and you can see if you really want to pay $13,000 for a 2.9% loan, you can do that. They're going to let you do that. But normally what I suggest is, try to figure out, you guys are first-time home buyers, try to figure a way to get the cheapest loan possible and see what that rate is, because you can see here, like, even though you pay an extra $500, you're only going to save like $20 a month here, and it's going to take you 20 months or so to kind of get that money back. So you kind of have to do the math a little bit. I recommend most people just go with a free loan or a slightly inexpensive loan. So like a 3.875 or a 3.99 are probably the ones I'm going to go with. You obviously wouldn't want a 4.0 because this loan basically costs about the same. And you can see here, like, some of these loans actually will pay you, and so this one's paying you $742, and I use that word pay loosely. Basically what it means is that they're going to give you so many credits here that it's going to cover some of your closing costs, which is actually a good thing. If you don't have a lot of money for a down payment and you're already strapped, you can go that route as well. And one other thing that they will actually do is, once they figure out what this amount is, some of this credit will actually go towards this. So that's kind of nice as well. But you obviously don't want to get too much of a credit, and you can see here it kind of is at the end of the list already. Because you can see here, like, you might want to get a better rate, because long term, this low interest rate is going to cost you a lot less than trying to go with a free or a loan that pays you to close. One thing you want to do is make sure that you pick the right loan, because this loan is going to stay with you for a very long time. And if you notice, it is a 30-year loan, so it will stay with you for 30 years. It's not going to magically disappear. So you want to make sure that you get the right loan, you get the lowest possible price, you get a decent monthly payment that you can afford, and you don't want to regret buying too much house and not being able to afford it. So now that you've gotten pre-approved, let's say you use my lender that I recommended, your real estate agent isn't going to like that. And the reason why I say that is because they're not making any money off the side or anything like that, but they're not going to like it because it's not a local lender and they can't actually go and talk to that lender. And so what they're going to suggest you do, and I think you probably want to do this, is to get pre-approved again. And it's kind of a weird thing to say, because you already proved that you can afford the home through another lender, but they want you to get pre-approved again through a local lender. And the reason they do this is because they have no idea who Box Home Loan is, right? When I bought my home in 2009, nobody knew who Quicken Loans were, and they were just like, we don't trust them, right? So you're gonna have to bite the bullet and do another pre-approval, and you're gonna have to submit more documents and all that. But the reason why you want to do that is for when you actually put your offer in, you're going to want to show them that you actually have pre-approvals from multiple banks, and it's going to kind of enhance your offer, because people who put offers in that don't have any credit or any pre-approval letter just means that they haven't really gone through that process yet, right? They may not even get pre-approved for a loan. They may think they can get pre-approved, but then realize, oh, I have so much debt, I can't get pre-approved. So having a lot of that taken care of, and getting multiple pre-approvals, one through a preferred lender and one through the local lender, even if you don't use the local lender, is going to help you out. So, and by law, they can't force you to use the local lender. It's in the real estate contract that you can choose and use whichever lender you want. That's just one thing that the seller is going to have to agree with. And most online lenders will use a local title company, so it ends up being the same thing. So once you get your pre-approval letters, you're kind of pretty much ready to start, literally making offers on homes. One thing you want to be mindful of is, looking at the good faith estimate on your pre-approval. And that is kind of telling you like how much your loan is costing you, over the lifetime, how much your monthly payment is, how much interest you're going to pay if you were to pay it out over 30 years. And you're probably going to ignore all these numbers, because that's what I did when I was younger. And you have to realize that if you were to pay this entire amount, your $200,000 home is going to cost you like $550,000 or whatever it ends up being. And so just be mindful of that, and make sure that you're okay with that. And most likely you're going to be okay, because people get pretty emotional when they buy homes, and they just ignore all of that. All they really think about is, okay, can I afford the monthly payment? All right, we're finally ready to start looking at homes. So, let's say your pre-approval is $300,000, and that's what you can afford. What I suggest you do is look at a lot of the local real estate agents and check their websites. we notice that we haven't even contacted a real estate agent yet. Mainly because I don't really like to get bothered by real estate agents, because I may not even be serious about buying a house yet until I see the one I want, right? It goes back to that patience again. You want to make sure that that house has everything you want, everything you need, before you actually get to a step. I mean, you already got pre-approved. That's a pretty big step. But most real estate agents actually won't even deal with you until you actually get a pre-approval. And so, let's not contact the real estate agent yet. Let's go start looking at homes. So I usually check Zillow. Zillow's been a pretty good site in the last 10 years for looking at homes. And usually you'll be able to see like homes for sale, homes for in foreclosure or near foreclosure. And what you want to do is look in like areas that you're thinking about living in, right? Because one thing that you can't change about a house is where it's located. So you want to make sure, if you can afford it, to look in a location that is ideal for you. And one thing I suggest for a first-time home is to make sure that you're willing to live there for at least 5 years. If you're not willing to live there for at least 5 years, probably don't buy that house. Mainly because, let's say in 5 years, a lot can happen. You could get promoted, you could get a second income, you could get, a family, etc. You want to make sure that, that house is going to be still compatible with your life. Another tip that I have is, look at neighborhoods that have, slightly newer homes. I'm not saying buy the newest home or buy a new home or anything like that. But a lot of the standards have gone up on homes. You don't want a home that has like asbestos in it or, has old galvanized pipe. There's nothing wrong with these homes, but just know that, the maintenance is going to be a lot higher. And being a new homeowner, you're probably not going to know anything about maintenance. If you're renting, your landlord probably took care of that for you. But you want to make sure that, you're going into a home that's going to have, very little maintenance for you, because, maintenance can add up and it can probably kill your finances if you're not careful. So once you've determined some neighborhoods that you want to buy your home in, I suggest you see if there are any open houses around. Usually on Saturday or Sundays, real estate agents will kind of post open houses. And again, you don't need a real estate agent. You can just walk in there and look at the homes. Usually the seller's listing agent is there to kind of represent the home. And the nice thing about open houses is, even though you have your list and you thought it was finalized, you're probably going to see things that you want that you didn't know you wanted. For example, you could have wanted to live in a gated community and then realized when you got to that open house, you had to punch in a bunch of codes and thought, okay, maybe I don't want a gated community anymore. That's just one example. Or it could be like, you wanted a big backyard, and then when you came to that backyard, you saw how much maintenance and upkeep was required, and you realized, I don't want a big yard. So you're not going to know that until you see a lot of homes and you kind of realize what you can compromise on, because like I mentioned, you're never going to find that perfect home that has everything. And you want to make sure that you see a lot of homes and attend as many open houses as you can, so that way when you actually go and make an offer, that that's the house that you guys want. I think I looked at over 30 or 50 homes before I made an offer on that first home. I mean, in 2009 there were homes everywhere. Everything was foreclosed and short sales. One of the things that I was considering when I bought my first home was the fact that I wanted that home to be a rental down the road. And so, I told my wife, this house isn't, something that we're going to raise our kids in. Maybe it could have been. So schools weren't that important to me. It wasn't going to be a house that I'm going to live in long term. So, not having everything wasn't that big of a deal to me. And really it was more of an investment than a primary residence. And so, when we bought the house, you'll go through this cycle as well. You'll want everything in there. You'll want upgraded cabinets. You'll want upgraded whatever. And, you got to make sure that you stay disciplined and, just buy what you need. I mean, this is your first house. It's not going to be your last house probably, and it's definitely not going to be your dream house. So, just go in with that mindset and, make sure your partner's on board. One thing that you can also do if, let's say you're a single gentleman buying your first house, is to make sure that that home actually can make you some money. You actually can rent out rooms, and my wife and I did this for a little bit, and we rented out a room. We only charged the tenant $300 a month. It was a friend of ours, and it was extra income. You can't use this in a loan process. They're not even going to listen to you if you say something like that. But this is extra income. If your mortgage is $1,500, all of a sudden it just became $1,200. The longer you can do this, the more money you're going to have. All right, so now let's say you found your perfect house and you've looked at a bunch of homes, whether it's through the website, whether it's through open houses. In order for you to make an offer, you actually have to have a real estate agent. So there's two kinds of real estate agents out there. There's the listing real estate agent and the buyer's real estate agent. And I don't suggest you ever use the seller's listing agent, because every single house that gets sold on the market is subject to a commission, and that commission can range. It could be 5%, it could be 6%. Usually it's 5%, I've learned, and 2.5% goes to the seller, and 2.5% goes to the buyer's real estate agent. So the two real estate agents, they make a commission off every sale. So that's kind of why they represent you. That's kind of why they represent the seller, because they want to make that commission, right? So they want to show the house as best as they can so that people will actually buy the house. And so this actually doesn't cost you anything. And, like I mentioned, if you heard me earlier, I mentioned the seller pays this fee. So the seller pays a 5% commission between the two real estate agents. And so for you to get a real estate agent, it actually costs you nothing as a buyer. So you should always get a real estate agent. I mean, you actually need one to make an offer anyway. So, but don't include them until you've done a little bit of your own research, because sometimes the real estate agents can be kind of slow, and maybe I got a bad one, but they're gonna go in and find homes for you. You're gonna give them that wish list that you want. You're even gonna give them the houses that you've already looked at, right? And they're gonna be surprised, like, okay, this person has already looked at a lot of these, which is good, because that kind of like eliminates a lot of the guesswork for them. Because what they'll do is they'll give you some feeler homes, and maybe they won't fit your neighborhood, maybe they won't fit your criteria, but it'll have some of the criteria, so they can kind of validate that you actually want those criteria. So it may be in a bad neighborhood, but it may have like that swimming pool you wanted, and so you can go look at it and say, yeah, I definitely want a swimming pool. So they'll kind of use that to narrow it down, and they'll give you listings, and even new listings, right? They may have new listings that are not actually posted yet, so like some of those pre-foreclosure homes that I mentioned on Zillow. And they'll kind of give you a report and show you all the details about it. Zillow doesn't have all the information. They may not have this something hidden about that house that you don't know about. Maybe there's a basement, I don't know. So they'll have that information. And one thing they actually can do for you also is, look at comps in the area. And so what I mean by comps is, there are going to be other homes that are sold in that neighborhood in the last year and a half, 2 years, and they can pull that information out and kind of show it to you, because that information is going to help you with your offer. You obviously don't want to overpay for the property. You can use a Z estimate. It's highly inaccurate. They have no idea what the house includes. But you can use it as a ballpark, because the Z estimate uses all that, government information, the county information to kind of figure out what homes are selling for. But you'll want the actual numbers, right? Because you can say, okay, I want to buy this, 1,500 square foot home in this neighborhood. What are the other 1,500 square foot homes selling for? Or what have they sold for in the past? And what are there may be another home down the street that's listed for the same price, right? And so, you can calculate square foot, the amount of money per square foot. That would kind of give you an idea. It could be $79, it could be $100 a square foot. But having that data will kind of, show you, what a reasonable offer is for the house. All right, guys, let's talk about putting down the offer. And so your real estate agent is going to help you here and make sure that you're putting in a fair market value offer and not overpay for the property that you're interested in. So one of the things that they're going to do is look at the comps. You can look at the comps as well. They're going to share that report with you. They're going to calculate things like price per square foot and kind of recommend something. And you're going to want to make sure that you don't overpay for the house. And there's several reasons why you don't want to do this. One, you're not going to get your loan funded. Remember that loan to value? So that loan to value is based off of the appraisal of the property, not the purchase price of the property. Usually the purchase price and the appraisal is going to be very close or the same, but you're going to want to make sure that it's as close to that appraisal as possible, because even if you try to put 20% down and that appraisal number is much lower than your purchase price, it's not really an 80% loan to value at that point. And so that's something you have to consider. Now the seller's listing agent knows this as well, and they're recommending the same thing to the seller, because no one's going to overpay for a house the bank's not going to fund a loan if it's, over the amount of the appraisal, unless the buyer is willing to bring in more money, which usually is never the case. I mean, no one in their right mind ever wants to buy something that's, that costs more than what it's worth. At least I hope so. Another thing that your real estate agent may tell you to do is to put in an earnest deposit. And all an earnest deposit is just money that you're going to put in with the offer, and letting the seller know that you actually won't back out of the offer, because, I mean, there's really not anything really stopping you from backing out of the deal after you put your offer in. A lot of these sellers are getting like 10 offers a day, or 5 offers a day, whatnot, and who knows what any if any of them are actually legitimate. But if you put money down and tell them, like, here's $1,000 or here's $3,000 or whatever the amount is, they're going to know that your offer is serious. They're probably going to look at your offer first. They're going to look at your lender, your loan, and make sure that you're actually going to afford it. And if everything is good, they'll probably go with your offer and accept your offer. So another thing that you may ask for, and this may not be as prevalent today as it was back in 2009 during the recession, but you're actually going to try to ask for closing costs. And this will probably be more helpful later after you do the inspection, but you can actually ask the seller to pay for some of your closing costs that the lender is charging you. So when I bought my first property, I was able to ask the bank, who was the owner at the time, for up to 6% of closing costs, and they actually paid for a lot of the closing costs, actually all of it. And so it ended up, saving me, I think up to $7,000 or something like that. So it doesn't hurt to ask. You can ask for 3%. You can ask for anything. Ask your real estate agent. They may have a recommendation. All right, so your offer's in, and you're kind of waiting patiently. It might take a day or two, maybe 3 days. It really depends on the seller. They may want all the offers to come in, maybe an open house, and they realize there may be 10 offers coming in. So they're going to wait for all of the offers to come in to kind of see, the highest bid, or did anybody put an earnest deposit down, or, are these people pre-approved? They're going to look through that list, because, every time they accept an offer, they have to realize that, if it falls through and falls out of escrow, they have to start all over again. They may not get that buyer again, right? Let's say my offer was in there and they didn't take my offer. I may have gone and put an offer in another house and bought another house. So they're going to be reviewing these offers, and the listing agent's going to make a recommendation, obviously. So you just got to be patient. It may take a couple days for your real estate agent to call you back. Just go walk in the park, do something to take your mind off things, because you're going to get really antsy during this stage. You're going to pester your real estate agent. Your real estate agent is going to tell you there's nothing they can do. So one thing that might happen after you get your offer back is they may counter offer you. And, let's say you went in like $10,000 below asking, and, your real estate agent may have suggested that to you. Or you may have gone full purchase price, right? And sometimes, oddly enough, even if you go full purchase price, they may actually counter you with more money. And the only time this really happens is if, let's say, the seller met you at the open house and they really liked you, right? And they said, I really want to sell this house to this person. And they may be using it for their own advantage. And this is actually what happened in one of my other real estate deals. And they may be trying to take advantage of you at the same time. And so, they realize they have something that's worth a lot and people are willing to pay. And, they may have noticed, hey, I can sell this for $10,000 more. So they may actually counter you and charge you or try to make you pay more. And, one thing that you have to be disciplined about is, what I mentioned earlier, is the appraisal. The appraisal dictates pretty much everything, unless you have a lot of cash and you don't care. But you want to make sure that, again, you're not overpaying on something, because that appraisal may come in at that exact purchase price. I mean, that's why the listing agent picked that purchase price for the seller. And so, one thing that might happen is you may get countered. It may be $5,000. It may be $2,000. It's probably not going to be 2, but 5 to 10, anywhere in that range. And what's going to end up happening is you're going to get really emotional. And at least my wife and I, it was only $10,000 more, right? Like, why couldn't we just buy that? I mean, $10,000 more equates to about $50 a month, and so most people will say that's a no-brainer, right? But if you're looking at a house and you realize, this house has been on the market for like over 30 days, and I put in a full purchase price offer, and they didn't accept it. Something is weird. Something weird is going on, and so you don't want to get emotional on the property. There's going to be other homes out there. Yeah, it's going to be a long process and you may have to wait, but you never know. The market could crash next year, 2 years from now. You could be saving a ton of money because of that mistake. Or, it could go the other way, which then you're going to have a lot more regret. So once your offer is accepted, you're actually officially in escrow. And so one thing that you want to make sure you don't do is you don't go and buy things on credit because one of the things that happens during escrow is underwriting, and underwriting is literally just verifying all of the things that you said, and your credit report is still accurate, and your income is legitimate. But you don't want to change anything, right? And so because they're going to run a credit report again, and they're going to make sure that nothing has changed since the last time. You didn't go and buy a new car, or you didn't go and finance a bunch of appliances, things like that. You don't want to surprise your underwriter because they're going to call you and ask you, what is this and why'd you do that? So you're going to be running around gathering documents during this time. The escrow process can take, a pretty decent amount of time, 30 to 45 days. At some point in that time period, your lender is going to want you to lock down on a rate. And what that means is, every day your interest rate changes, the market changes, Fed rates change, and you're going to have to make a call to when you want to lock down your interest rate. And it could go up, it could go down, it's only going to be slight. You can gamble a little bit, you'll have a certain amount of days until you have to, finalize that rate. But you'll want to lock something that is close to what you originally agreed to because your monthly payment's based off of that. And once you do that, everything just happens in the background, and the underwriter is going to call your place of employment to verify your income and that you still work there. It's always a good idea to give your HR a heads up. They have dedicated people for this, but just letting them know, hey, you might expect a call from so-and-so. They might be verifying my income, etc. It'll kind of speed things along because you don't want them to hold up the process because they could. They could be really busy. Could be annual reviews or something happening at that time, and you're trying to get income verification happening. Another thing you don't want to do is suddenly deposit a bunch of money in your account. People normally don't do this, but let's say you had, money in your laundry, under your mattress or something that you said, oh, I don't need this emergency fund under here anymore. I need to put it in the bank. You don't want to do that because the underwriter will ask you where that money came from. And if it's a sizable amount, like over $2,000, they're going to definitely ask you. So you don't want to raise any red flags like that. Just keep the money where it is and wait until after you close escrow to do that. And similarly, you don't want to withdraw any money because remember, you have to have those reserves in there and you have to have enough for a down payment. So making sure that you don't make any large changes like that. Obviously, your payroll and things like that going into your account is normal. They're expecting that to happen, so that can just remain the same. All right, now that your home has been accepted and the seller has accepted your offer, you can celebrate a little bit. We're not really through the weeds yet because you've seen the house, you loved it, the offer was accepted, which is great news. But one thing that you want to do after this, and your real estate agent is going to recommend this, is to get a home inspection. And the reason why you want to get a home inspection, and this is completely optional by the way, but you definitely want to do this because this is the thing that will benefit you. And sometimes you may argue like, okay, what happens if I don't buy the house? Well, you're kind of already committed to buying the house at this point, and you want to make sure that the house you're buying actually works properly, right? It's like buying a car and having a mechanic check out the car, right? Make sure the engine's running good, the suspension, the transmission, etc., whatever it is. A house is no different, right? So the inspection, generally runs around, $200 to $400 nowadays. I think my first inspection cost me $150. And what they will do is come to your house, they'll arrange a time, the real estate agent will let them in, and your real estate agent may actually have someone in mind that he or she will recommend to you. But they'll check out your house. So they'll do things like go on the roof, check all your tiles, check your shingles, whatever you have up there, and let you know the condition of it, if anything's missing, etc. They'll check your fence, they'll check all of your appliances, they'll run them all. They will climb in your attic if you have an attic, and they'll check things in there. They will make sure your faucet's working, make sure your toilets are working, Some of them will even go around, look at all your outlets, make sure they're not broken, and they'll kind of come up with this huge list of things that potentially need to be fixed before you actually move in. And what you can do with that report is you actually can take it back to the seller and ask for a discount on the purchase price. And more often than not, it probably will work because these are a lot of things that need to be fixed, right? It could be like $20,000 worth. It could be $100,000. God forbid, it's probably not $100,000. But it could be something really small. It could be like $1,000, right? And remember earlier I asked about, I talked about closing costs. So you can ask them for $1,000 credit to closing, right? And these things may be super minor that you may not need to fix. So my first house, when I did the inspection, I had a couple problems. They were very minor. And I already had all my closing costs paid, but I wanted to do the inspection because I wanted to have peace of mind before I moved in. And so the first thing they found was a faucet that was leaking, which I already knew because I already saw that it was leaking. It was in the kitchen. And then the second thing they found was my toilet in the master bedroom was leaking a little bit. And it wasn't leaking into the house, it was leaking inside of the bowl, which meant that it kept refilling the bowl every, 10 minutes or so. And then the third thing they found was in the attic. They climbed in there and they said that something was, pulling up, and they recommended that I just went up there and cleaned it, which I never did actually, and it ended up being nothing. So, all in all, the inspection was, $125, and they found about $200 worth of repairs, which was very, which is almost like nothing, right, these days. So I ended up just fixing everything myself. This is one of the things that you're going to have to learn as a homeowner is to fix things yourself. Otherwise, you're going to pay a lot of money to someone else to do it. I think they were going to charge me about $300 total, $200 for the faucet and $100 for the toilet. I ended up fixing everything for, I think, less than $100 or $150. The toilet was like $2. It was literally a gasket that was going bad. And the faucet, I just bought a faucet at Home Depot. Now, if your inspection didn't go well and there's like way too much damage, especially for like older homes. The home that I bought was built in 2007, so it was pretty new, and it was in 2009 when I purchased it. So I knew there wasn't going to be a lot of problems. But if things go really bad, you actually can pull out of your offer at this point, and you can let your real estate agent know, like, there's over $20,000 in damages here. I don't have the money to fix all of that, and some of these are critical. You actually can pull out, and you can talk to your real estate agent about that. You can get your earnest deposit back as well. But if the seller is willing to work with you, if you really love the home, you can always negotiate the purchase price with them. They can go down lower. They can, they can offer to do the repairs for you. Things like that. So, it doesn't hurt to ask. But at this point, you can start over and go find another house, or you can, try to move forward with that house with a lot of the damages being repaired, hopefully. All right, so once you have your home inspection done and let's say everything goes well and you're fine with it, one of the things that your lender is going to want you to do is go and get a home insurance policy. And I know you're not going to use this yet, and they're going to tell you what date to use for the the start date, but they want to make sure that you have home insurance for your house. And the reason why they want this is because when you calculate your monthly payment, it includes things like your property tax, your principal payment, your interest payment, and your home insurance payment. And so they call this PITI, P-I-T-I. It just stands for payment, interest, taxes, and insurance. And they need that last piece to kind of finalize your monthly payment. So don't be surprised if your monthly payment is a little bit different from your original good faith estimate, because they don't, they just used a general rule of thumb for the number. And usually you're probably going to go lower than that because they just use a really high number so that they have something to work with. So when I bought my first house, I didn't really know much, and I just went with any old agent that my real estate agent suggested. And I think my policy ended up being about $800 a year, or maybe a little bit less than that. I can't remember. But one company I would recommend you try is Lemonade, and I use Lemonade now for my current home. And their rates are significantly cheaper. I think I pay about $600 or $700 a year right now, and my property that I have today is probably worth twice as much as my other property. And so, I'm paying less than what I paid, 10 years ago. So you can try Lemonade. It's an app you can download on iOS or Android. They let you customize your policy to what you need, rather than using kind of pre-baked formulas. What a lot of home insurance companies will do is they'll do like, here's what your property is worth. We'll give you coverage up to that, and then they'll say like 25% of it is something else. What Lemonade lets you do is it lets you kind of customize each parameter, right? So let's say like part of the home insurance policy, you can get something called property insurance. And property insurance is just your personal property. Like, if the house were to burn down, how much coverage would you need to, replace all of your personal property? And a lot of them, they just use a percentage. And, I was looking at my property and I'm like, I don't really care about a lot of the stuff I have in this house. I mean, if I lose all my family pictures, that would be devastating, but you can't really replace that. And so I went way down on personal property. I think I have like $160,000 on personal property on my insurance policy. But if you went with a traditional insurance company, they'll probably force you to do a percentage of what your house is worth. So check out Lemonade, and if you guys like it, let me know. I'm not sponsored by them, again, just trying to save you guys some money. So this escrow process can take some time. It takes them a long time to kind of verify everything, get everything done. They have to mail documents back and forth, etc. You just got to be patient. You're going to hate the whole entire process because you just want to move into your house. You've already made that commitment, and you're going to want to just move in, buy some furniture, do whatever. There's going to be a lot of temptation to do that, but you have to make sure that you don't disturb the escrow process. It can take anywhere from 30 to 45 days to kind of close escrow. Now, one thing that you do want to do while you're in escrow is learn how to wire funds to the escrow company. And so you'll get some escrow instructions right before closing, and they'll give you a number, an account number, which bank to wire the funds to. You'll want to go talk to your bank or credit union or whoever you're using to kind of understand what the wiring process is going to be, what the fees are. And usually it's just, you just take that little piece of paper that your title company has given you and you just give it to your bank, and they will wire the funds from your account directly there. So you'll have a small window to do that, and that's to make sure that your down payment is there and your closing costs, not your reserves, only your down payment and closing costs, because those two amounts plus the lender's loan is going to fund the purchase of the home. And so those funds together get wired to the seller, and then a portion of that obviously gets wired to the real estate agents or wherever they're working for, so that they get paid their commission. And so just understanding that you need to wire some funds near the end into some mysterious title company's bank account is going to be something that you're going to need to do before you close. So right before closing day, usually the day before, the title company is going to call you, and they're going to tell you that you need to come into their office to kind of sign the final paperwork. And if you recall earlier, you had a good faith estimate and all the documents from the pre-approval. At this point, everything is finalized, and they're going to have you come in and sign everything that you need to transfer the home to you. So loan documents, the deed, the title, and all that, who's going to be named on the property, and they're going to invite you in and do all of that on the final day. There's going to be a lot of signatures, and you're basically signing over your life and agreeing to pay this 30-year mortgage. But once you do that, then the loan can actually fund, and fund just means it can actually be distributed to the seller now. And usually that happens like the day after, or it depends if the bank is open, but usually it happens the day after. So once the real estate agent gets the keys to your house, usually he or she will call you and let you know that everything is good, your house is closed, escrow is closed, and they're ready to give you the keys. So they'll meet you at your house, and at that point they'll give you your keys, and if they're really a really nice agent, they might even give you a small gift. I think our agent gave us some wine and some kitchen supplies or something like that. I've seen some agents give people refrigerators. Their purchase price must be really high. I don't know. But at that point you can decide to do what you want. You got a blank slate. You can paint, you can renovate, you can buy appliances at this point. No underwriter is going to call you anymore. You can go buy that car you wanted now. You can even deplete all your reserves. I don't suggest doing any of that, but now you have your first home and you can enjoy it and you can make it your own for the next 5 to 10 years or however long you plan on staying there. Hopefully these tips were helpful for you guys. I know this is a long video. There's a lot to be talked about. I haven't even scratched the surface on some of the things that you can look out for during the escrow process, but maybe I'll make a video in the future about that. But for now, thanks for watching. Hopefully you learned something. And if you liked what you heard, please smash that like button and subscribe for more.